When people picture a financial meltdown, they think of stock tickers crashing, traders shouting on trading floors, or panicked investors leaping from buildings. But the most destructive collapses don't arrive with theatrics. They start with a single domino tipping over in a quiet boardroom, triggering a chain reaction that wipes out everything in its way. On September 15, 2008. That domino was Lehman Brothers. And what followed didn't merely rattle Wall Street, it brought the entire global economy to a standstill. Let's rewind. For more than 150 years, Lehman Brothers had stood as a cornerstone of American finance. Founded in 1850 by three German immigrant brothers in Montgomery, Alabama, the firm had endured the Civil War, the Great Depression, 2 world wars, and multiple market crashes. By 2008, it was the 4th largest investment bank in the U.S., overseeing more than $600 billion in assets. Lehman wasn't just another bank. It was an institution trusted by governments, corporations, and investors worldwide with their most essential financial operations. Yet behind the polished lobbies and confident earnings reports, Lehman had taken a disastrous gamble. The bank had leveraged itself to extremes on mortgage-backed securities, especially subprime mortgages issued to borrowers who were never able to afford them. While housing prices climbed, it looked like brilliance. Each bundled mortgage sold generated fees, and every fee turned into bonuses for executives who convinced themselves they had found a perpetual money machine. The numbers seemed to confirm their belief. In 2007, Lehman posted record profits exceeding $4 billion. What they failed to comprehend, or deliberately ignored, was that they were building their empire on sand. By early 2008, the fractures were clear. Housing prices had peaked and begun to drop. Foreclosures surged. The mortgage-backed securities in Lehman's portfolio were turning worthless. But instead of recognizing the danger, the bank doubled down, continuing to buy toxic assets and using accounting maneuvers to hide losses from regulators and shareholders. Warning signs were everywhere. Bear Stearns, another major investment bank, had collapsed in March 2008 and needed a government-coordinated rescue. Fannie Mae and Freddie Mac, the massive mortgage giants, were taken over by federal regulators just days before Lehman imploded. The message was obvious. But Lehman's leadership believed they were too essential to be allowed to fail. They assumed that if Bear Stearns deserved a bailout, then surely Lehman Brothers would receive the same aid. They were catastrophically mistaken. That September weekend, as Lehman executives desperately searched for a buyer or government lifeline, Treasury Secretary Henry Paulson and Federal Reserve Chairman Ben Bernanke made a decision that would permanently alter the global financial landscape. They would let Lehman Brothers collapse. The message was unmistakable: no institution, no matter how large or interconnected, was guaranteed rescue. What made Lehman's fall so destructive wasn't simply the failure of a bank. It was the collapse of confidence itself. When Lehman filed for bankruptcy that Monday morning, it triggered the largest bankruptcy in U.S. history up to that time. Nearly $600 billion in assets evaporated overnight. Thousands of employees lost their jobs. Investors who had entrusted Lehman with their savings watched their wealth disappear. Yet the true nightmare was only beginning. Lehman Brothers wasn't a standalone entity. It was woven deeply into the architecture of the global financial system, like a strand in a vast spiderweb. When that strand snapped, the entire web began to fall apart. The bank had counterparty relationships with almost every major financial institution worldwide. It borrowed from some, lent to others, and was entangled in complicated derivative contracts with thousands more. Once Lehman failed, each of these relationships turned into potential losses for someone else. Credit markets, which had operated smoothly for decades, froze instantly. Banks stopped lending to one another because no one knew who might become the next Lehman. The commercial paper market, the lifeline for corporations needing to fund daily operations, locked up. Companies that had operated for decades suddenly couldn't pay suppliers or employees because they were cut off from essential short-term financing. The panic spread at terrifying speed. Within days, AIG, the largest insurance company in the world, required an $85 billion government bailout to avoid collapse. Washington Mutual, the biggest savings and loan in the U.S., failed just 10 days after Lehman. Wachovia, the fourth largest American bank, was forced into an emergency merger to prevent insolvency. Dominoes were falling so rapidly that regulators couldn't keep pace. And the crisis didn't stop at America's borders. European banks had bought massive amounts of the same toxic mortgage securities that destroyed Lehman. When those assets turned worthless, Europe faced its own meltdown. Iceland's entire banking system collapsed and required an IMF bailout. The Royal Bank of Scotland, once among the world's most powerful banks, needed the largest bailout in British history. Institutions from Germany to Japan suddenly found themselves holding paper they once believed was as safe as government debt. Global stock markets went into a free fall. The Dow Jones plunged more than 500 points on the day Lehman went under, and continued dropping. By March 2009, the S&P 500 had lost over half its value from its 2007 high. Trillions in wealth simply disappeared as investors fled to anything resembling safety. The human impact was devastating. As banks refused to lend and businesses lost access to credit, U.S. unemployment jumped from 5% to 10%. Millions of Americans lost their homes to foreclosure. Retirement accounts built over decades were slashed in half. College savings vanished, forcing families to abandon long-held plans for higher education. What began as a mortgage crisis had grown into a global economic disaster. The Great Recession, as it later became known, was the most severe downturn since the 1930s. And it all began with one weekend decision to let Lehman Brothers fall. The shockwave spread faster than anyone expected. Within Hours of the bankruptcy announcement. Money market funds began breaking the buck. These funds, long considered among the safest savings vehicles, could no longer guarantee that investors would receive back every dollar they deposited. The Reserve Primary Fund, which had invested heavily in Lehman's commercial paper, saw its share value fall below $1 for the first time ever. Terrified investors rushed to pull out their money, sparking withdrawals that swept across money market funds nationwide. This was no longer a Wall Street story. Money market funds held the emergency savings of ordinary Americans, the cash reserves of small businesses, and the temporary holdings of pension plans. When these supposedly bulletproof funds began to fail, the message was clear. Nothing was safe. The trust that underpins every financial system was splintering, and those fractures were widening quickly. Corporate America felt the shock immediately. Companies that depended on commercial paper found their access to cash suddenly cut off. General Electric, one of the most stable U.S. corporations, watched borrowing costs skyrocket overnight. Ford Motor Company saw its credit rating tumble as investors questioned which iconic brand might fall next. Even McDonald's, with its steady stream of fast food sales, faced higher borrowing costs for basic expansion. But the harshest blow struck the housing market, the very source of the crisis. Lehman's collapse didn't just damage confidence in mortgage-backed securities, it annihilated the entire structure that had funded homeownership for years. Banks that survived the initial subprime meltdown now faced a different obstacle: they couldn't sell the mortgages they originated because no one was willing to buy them. Without the ability to offload mortgages, banks stopped issuing new loans. Without new loans, home sales collapsed. The vicious cycle intensified. As fewer people qualified for mortgages, home prices fell even faster. As prices dropped, more homeowners found themselves underwater, owing more than their homes were worth. Rising foreclosures caused additional losses for banks holding existing mortgages. Communities across the country watched entire neighborhoods empty as families abandoned homes they could no longer afford. Small businesses, the backbone of U.S. employment, were crushed. They couldn't secure loans for payroll, inventory, or basic operations. Their customers, fearful about job security and falling home values, stopped spending. Long-standing businesses that had survived generations closed within months of Lehman's collapse. Main streets turned into rows of vacant stores and "for lease" signs. The psychological toll was immense. Americans who had believed that hard work and disciplined saving guaranteed stability saw their expectations disintegrate. Families who had done everything right suddenly faced bankruptcy through no fault of their own. The social contract that had defined American capitalism for decades seemed to vanish overnight. Governments worldwide scrambled to contain the disaster, but their interventions often fell short. The Federal Reserve slashed interest rates to near zero, yet banks still refused to lend. Congress passed stimulus measures But the funds couldn't reach the real economy fast enough. European Central Banks coordinated emergency lending programs, but trust between financial institutions had eroded so deeply that even government guarantees failed to restore confidence. Global trade collapsed. Container ships sat idle in ports from Los Angeles to Rotterdam as international commerce froze. Countries reliant on manufacturing exports saw GDP contractions not witnessed since the Great Depression. The same interconnectedness that had fueled globalization for decades now became the mechanism spreading economic contagion. What set this crisis apart from earlier financial panics was its scale and speed. Historically, banking crises were mostly national events. But Lehman's failure proved that a single institution's collapse could endanger the entire global financial system within days. The complexity of modern finance, with its derivatives, securitizations, and cross-border exposures, meant that no one fully understood where the next shock might emerge. Central banks discovered that their traditional tools were ineffective against this new kind of crisis. Cutting interest rates was meaningless when banks wouldn't lend at any price. Injecting liquidity failed when the problem was solvency, not liquidity. Guaranteeing deposits didn't rebuild trust when the entire system appeared rotten. The collapse exposed just how much of modern finance had been built on illusion. Lehman's balance sheet, like those of many other banks, had been propped up by accounting tricks and regulatory exploitation. The advanced risk models designed to prevent disaster failed catastrophically. Rating agencies responsible for identifying safe investments had been captured by the very institutions they were supposed to police. As the crisis deepened throughout late 2008, it became obvious that this was not just another recession. It was a system-wide breakdown of the financial order that had powered global growth for decades. The question was no longer whether the damage could be contained, but whether the world could rebuild from the wreckage Lehman left behind. The fall of Lehman Brothers wasn't simply the demise of one firm. It was the moment the world learned that the financial system it trusted was built on deception, excessive leverage, and wishful thinking. What began as a mortgage crisis in American suburbs became a worldwide catastrophe that destroyed trillions in wealth, cost millions of jobs, and shattered the confidence binding modern economies together. The lessons of Lehman are as urgent today as they were in 2008. Financial institutions still gamble recklessly with other people's money. Governments still believe they can manage crises that escalate faster than human comprehension. And ordinary people still put faith in systems that value profits over stability, complexity over clarity, and short-term gains over lasting security. History shows that every financial bubble follows the same script: euphoria, excess, and eventual collapse. The players change, the instruments evolve, but the human emotions driving booms and panics remain unchanged. Lehman Brothers was not an anomaly, it was inevitable. And unless we learn from the events of that September weekend, it will happen again. The next time someone claims an institution is too large to fail, remember Lehman Brothers. The next time you hear that this time is different, remember September 15, 2008. Because in finance, as in life, the most dangerous words are always, it can't happen here. If this helped you see how fragile the financial system truly is, hit subscribe. History holds the warnings, and I'll show you where to find them.